Hello, and welcome to the video on the premium valuation approach on how we maximize your valuation through business staging. Just like a house, you want to properly present your business prior to going to market, and that means getting all of your house in order. In the 12 to 24 months before you exit, there's a number of key staging activities that will increase your value and your likelihood of closing. We're going to talk about something called a 5-for-1 mentality. We're going to talk about how to get your add back structure in place. We're going to talk about avoiding key mistakes before you go to market. And we're going to talk about a strategic plan to address what I like to refer to as the top 10 deal killers. Okay, let's get started. So as you know, by looking at this sheet, the premium valuation approach, we've completed the strategize section, and we're now focusing on the maximizing the value, and we're in the preparation area, specifically in the business stage for exit. We're going to talk about these four things: implementing 5-for-1, which means that every dollar of profit is actually worth $5 in a deal. We'll talk about add backs and making sure not just the add backs, but the structure is in place to set precedent. We're going to talk about key mistakes you need to avoid. And then we're going to talk about how do you mitigate deal killers that might be out there and ruin you getting a premium valuation. The first one is 5-for-1. And if I had to go back and think over the last 5 or 6 years that I've been advising people on how to get premium valuations, or all of the presentations that I've done and gotten feedback from sellers, this would be in the top 3 things that sellers have consistently told me, Scott, I'm so glad you told me about this concept. It really helped me increase not only the valuation of my company, but helped me run a better company. And it's called a 5-for-1 mentality, and it's one of the most powerful ways to increase your valuation. Let's use the example of Willie's Wines. Willie's Wines is doing pretty well. They've got $500,000 in earnings, as you can see, and the trailing 12 months revenue is $2.5 million. And he's got an offer on the table, let's say, for 4x multiple. That means that if you take the $500,000 times 4, that means it's a $2 million valuation. Willie manages to figure out how to save $10,000 in costs. Okay, so you say, well, that's nice. Why did that $10,000 in costs get multiplied by 5-for-1? It's because Willie's earnings then went from $500,000, because I saved $10,000 worth of costs, they went to $510,000, and then you get the multiple of the 4x multiple on that. So the sales price went from $2 million even to $2,040,000. Well, wait a minute. If it's only a 4x multiple, why is it called the 5-for-1 principle? And the answer is because you got not only the valuation increase, but you actually got the $10,000 as well. So if you think about that concept in mind, and remember, no one can guarantee you a multiple, but the principle applies no matter what the multiple is that you use. That's called the 5-for-1 mentality. And now let's talk about how we can make that as a powerful force in your business. The action item is to do what I call a 5-for-1 audit prior to going to market. And this is in your workbook, so you've got an ability to do this. First, what you do is you look at, where are all of my expenses coming from? The age-old you can't get blood from a turnip kind of approach applies, where if most of your costs are in your cost of goods sold and in your marketing expenses, we want to focus there first. The first thing is see the power that this can do. This can add hundreds of thousands of dollars onto your valuation or more. And I'll give you just a very simple example. If you have a $50 subscription that you might go, oh, I might use it someday, it's very easy to sign up for something that's supposed to help your business. The money back guarantee period ends, and then you're just left with that $50 expense. But did you know a $50 a month expense actually cost you $3,000 in valuation? Yep, because the $50 a month times 12 months is $600. And if you use the 5-for-1 principle, $600 times 5 is $3,000. And that's just on something that costs $50. That allows you to go to the second point, is I call it make it fun. When I exited my first business, we had a great time trying to figure out all of the ways that we could leverage the 5-for-1 principle and motivate yourself and others in your company if you have key leaders, and track every time that you figure out a way that maybe you shut off that negative keyword that's not doing so well. It has a high ACoS at 10 o'clock at night and it saves you an extra $100. You just added another $500 onto your valuation. Do this month over month in the 2 years before you exit, and I guarantee you will add significant dollars onto your valuation. However, there's a big caveat. Don't use this as an excuse to slow down your growth. The whole point of this is that when you grow rapidly, you tend to build up a lot of expenses or other types of things that you don't need in the company. But don't ever use 5-for-1 as a way to slow down your growth, because that will actually lower your multiple and can work against you. And then recognize that even though 5-for-1 is powerful enough on its own, in today's marketplace, you actually get a double reward. And what do I mean by that? If you can save money and increase the profit, you get the 5-for-1 like we just discussed. But did you know that a 15% profit business won't have as high of a multiple as something that has 18 or 20%? So not only are you getting the 5-for-1 principle as if the multiple is what I'd call static, but you're also getting the multiple lift by having a higher profit percentage. That's how powerful 5-for-1 is. Okay, let's talk now about add backs. And this is a very common topic that's talked about, but I want to add some additional advanced thinking into it. First of all, you want to make sure that your ongoing add backs are actually coded into your accounting system. And what I mean by that is having separate accounts. So for example, if you as an owner are taking out a wage and we know that that's going to be an add back or owner's travel, actually create a separate account called owner travel from other travel. The reason why you want to do that is you want to start setting the precedence with the buyer that these are personal owner-related expenses in the eyes of acquisitions versus something that might be included in the business on a go-forward basis. You also want to create a structure in place that you document all of your one-time add backs. So if you have a one-time lawsuit or some other type of anomaly, in your workbook, you'll have a section where you can list each one of them, the account name that it happened under, where the expense was recorded, what the dollar amount was, and then what the reason for the add back is. If you can imagine showing up with a buyer, having all of that laid out organized way, you have a far better chance of getting it. Then you also might want to consider whether or not you should have actually multiple entities, and I'll use an example of a consulting entity. If you help other Amazon sellers out and you travel to a lot of conferences and maybe you need software in order to do that, even if it's a part-time job, you can have a separate entity there and recognize that then those expenses don't need to be explained as add backs because they never hit the business in the first place. They were recorded in a different entity. Okay, now that we talked a little bit about the structure of add backs, let's talk about some guidelines. The following is a list of what I would call the definite add backs. Now, I say that knowing that nothing in life in mergers and acquisitions is definite, but interest expense is in the definition of EBITDA, meaning it's excluded. Any donations you're doing, gifts, depreciation, taxes or licenses, except for business taxes, but things like sales taxes would be. Corporation tax, sale of a business, so any of your transaction-related expense for advisors or brokers, or the financial preparation costs to make sure that you get through due diligence, foreign exchange currencies, and any related party management fees that you might have between companies. On the flip side, what's probably not going to be an add back for you is contractors or wage or personnel expenses, marketing expenses, telephone expenses for the business, or utilities for the business if you have an entity like an office or a physical property, and failed launches. And the reason that they aren't on failed launches is that the buyer's probably going to have some of those as well. And then there's a big gray area in the middle, as you can see the different lists here. And the key part that I want to mention on the ones that are in the middle is that it depends on how it's documented and whether or not you can make the case that it's either one time or that the buyer won't have the expense going forward. But here's another advanced tip that I want to add you that many people don't think about. They get very frustrated when a buyer doesn't accept a particular add back. But there's actually a second value to having a long list of add backs, even if some of them aren't accepted. And let's take failed launches and one-time stockouts as an example. And if I had Willie's Wines and Willie was selling wine accessories and he had a one-time stockout of 6 weeks on one of his lead products and it doesn't get counted as an add back, it still has the ability to help improve that trailing 12 months earnings over the year going forward. Because remember, the buyer only gets the future earnings is going to be higher than in the past. And that in itself makes it worthwhile to track all of this information to demonstrate that even though he made $500,000 last year, the ability to get to $600,000 or $700,000 this year is almost assured, if I could put that in quotes, because of the add back capabilities that he tracked. Okay, so let's talk now about from an action item perspective. Review all of your expenses before you go to market and do what I call a scrub for add backs. And yes, I literally mean looking into QuickBooks, looking at all of your major expense items or doing it with your bookkeeper and looking at any area where, for example, that your legal costs might be $300-400 a month and then 1 month it was $3,000. That's a potential for an add back. And along with that, generate your initial 5-for-1 action list. What are you going to do to implement a 5-for-1 mentality? For example, if you could even renegotiate with your supplier and save $20,000 over the course of a year through a little bit more negotiating power, you just added $100,000 onto your valuation, just like that. Finally, set a procedure in place to track the progress both on your 5-for-1 mentality and your add backs on a monthly or ongoing basis, and you'll be amazed at the difference that you can see in the valuation of your company. Next up, let's talk about how do you avoid some key mistakes prior to exiting. Number one mistake that I see is people don't forecast the growth potential of their company. And this leads either to undervaluing the business or, frankly, selling at the wrong time. Many people, the 12 months before they exit, they reduce their profit by having a stock out. You simply have to make sure that you have enough capitalization to be able to fund the growth initiatives that boost the earnings and make sure that you don't have any stock outs. Obviously, Amazon shutdowns, whether it be an individual listing or whether it be the whole account, not only is a loss of profitability, but increases the buyer's perceived risk. And remember, every one of these mistakes is costing you 5-for-1 if it's in the year before an exit. And then lastly, I'd like to talk about the key one of understating your COGS. It's critical that you go and look at the landed cost and make sure that your bookkeeping and your accounting records are in place to track the accurate costs of your products. And finally, make sure that you're not underreporting shipping and duties due to maybe inappropriate HTS codes and or your shipping provider underreporting the value of the goods that are being shipped. Next up is strategically planning for potential deal killers. As I like to say, almost every deal killer is solvable with some level of planning. Now, that's not true if you just don't have the authority to sell the company or if the company literally is shut down by Amazon. But the first strategy you think about is how can I avoid deal killers? And we'll provide you the list here shortly. Second, if there are some that are out there, how do you mitigate them before you go to market? Or how do you price it into the deal if you're at market? And then finally, if you can't mitigate it, you might just have to take on the exposure and recognize it's still better for you to exit the company than not. Here's an illustrative list only, and I'm not going to go through all of them here in this video, but this is all in the workbook. And as you can see, you list the deal killer, you list do you have it, yes, no, maybe. You list how do I mitigate it, and or how do I strategically plan to remove it prior to exiting my particular business. As we like to say at Northbound, if you can eliminate all of the ways that a deal might fail, you will have made great progress towards increasing the odds that it will actually close. And that's what staging your business does. So, prior to going to market, recognize there are specific actions that you can take that increase the value of your company by hundreds of thousands or even millions of dollars and increases the likelihood that you close a transaction. Please set the procedures in place to make sure that you maximize your value through great business staging. Thank you.